I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. Hi, good to see you today. Okay, let's not waste time, okay? Yeah. So we've been on group balance sheet as usual. I said it's quite a long one, but we're going to try as much as we can to cover, as much aspect as possible. Okay, so we've been on, various aspects of group balance sheet, especially in terms of adjustments. Okay, so we've done few scenarios. Okay, so you can just take the previous classes, then join us so you can be up to speed. So today we're still looking at, of course, it's consolidated, what they call group balance sheet. Okay, but here we're looking at loans within the word group. Okay, what can also be referred to as intra-group loans. Okay, so what we are saying here, basically, is that that of course you have the parent company and the subsidiaries. Okay, now what we're trying to say is that it is possible that the subsidiary gives loan to the holding company, or the holding company gives loan to the subsidiary. Okay, of course, where you have excess somewhere and then there's cash needed somewhere, so there can be, a way of helping, easing activities by way of giving out what advances. So it's possible that the parent company can advance the subsidiary, or the subsidiary can advance the parent company, of course, in form of loans, right? So you're like, instead of you going to the bank to get your loan, you can talk to, your subsidiaries, or your subsidiaries can talk to you as a holding company. So that's what we're looking at here today. So basically what it means is that the parent company, okay, gives loan to subsidiary. So basically it means that the parent company is giving loan to some, but then it's also possible that the subsidiary will give loan to the parent company. So it can be either way. Okay, but here we're looking at the fact that the parent company gives loan to the subsidiary. Okay, so it means that if the parent company is giving loan to the subsidiary, it means that the subsidiary is owing the parent company. So we have the book of parent, and then we have the book of the subsidiary. So it means that in the book of the parent, okay, the subsidiary is a debtor, right? That means that the subsidiary is owing the parent company. But in the book of the subsidiary, the parent company is a creditor in that sense. So what it simply means is that in the book of the parent company, subsidiary is owing the parent company. In the book of the subsidiary, the parent company is being owed by the subsidiary. So it means that if the parent company is holding, let's say, 10 naira against the subsidiary, then the subsidiary must also be holding 10 naira against the parent company. So if the book of the parent company says somebody is owing us 10 naira, okay, we expect that the book of God will say that we are owing parent company 10 naira. So at the point of consolidation, we expect that there should be like something like plus minus, so they should cancel they should cancel out, right? That is what is expected, because what you're owing me is what I will capture in my book, okay, and then what you get, you're being owed is what you also capture in your book. So that's sort of scenario. So here, sub is a debtor, here parent is a creditor. So we expect that the same amount should be So when we are consolidating, it should what? Cancel down. But it is possible that, for some reasons, okay, you can have it not being the same thing. And most especially, okay, maybe interest. Of course, you can have an arrangement where the money the loan is given at an interest. So let's say this 10 naira is given to the subsidiary at an interest of, let's say, 20%. So it means that what? Per annum. So if it is 1 year, every year we expect that basically that what? The subsidiary will pay 20% as an interest on the 10 naira. So it then means that what? Annually, there's going to be interest earned from the perspective of the what? Parent company, which is going to be earned from where? From sub, right? Let's say 2 naira. Now, from the book or from the what? Hold subsidiary, there's going to be what? Interest paid, okay, to what? Holding company or parent company, which is what? 2 naira. So we mean that, or what I'm trying to say is that where there is an interest on the loan, it will be more like an income to the company that is giving out the loan. It will be more like an expense to the company that is receiving the loan. So you must understand that aspect. So we expect that, as long as they are operating separately and they are capturing their transactions, we expect these things should have been captured. So we're saying that, any interest that is supposed to be captured on the loan will be captured by the parent company and will also be captured by in their respective books. But it is now possible that, at the point of consolidation, it's possible that the parent company will not have captured its interest, while sub would have captured. The other possible that sub would not have captured and parent would have captured. So in that scenario, we must ensure that any difference is eliminated first, so that you can have the loan amounts, to be equal and opposite. So what we're saying is that if there's any reconciliation difference, or there's any difference, maybe as a result of interest, which has been captured by one and has not been captured by the other, first of all, you must eliminate the difference. When you eliminate the difference, that will make the loan amount to equal and opposite, so that you can cancel out at consolidation. Then you now raise the journals for the interest element. Okay, so if there's something called intergroup services, just like saying, aside from the fact that of course this is part of a service where you're giving loan to yourselves at an interest. So that interest there is like a service charge. So you can have other service rendered by parent company to the holding company, or subsidiary parent company to the subsidiary, then subsidiary to the parent company. Of course, you can have that at a fee. So you capture them accordingly. Whoever is running the service is an income to that person. Whoever is paid or receiving the service is going to be an expense to that person or that company. So here, let's focus here. So we have talked about eliminating the difference, so that we can have the loan amount to be equal and so that I can cancel that as consolidation. So after doing that, now the interest amount, okay, will now be captured accordingly. So for interest earned, since it's an income, of course, don't forget your assets are debited, expenses, or let's say liabilities, credited. Expenses debit, incomes are credit. So from the perspective of of the parent company, interest earned is an income. Okay, so what do? We're going to credit what do you credit there now? You're going to credit your reserve or your profit and loss, because your interest earned is an income, right? So if you credit your profit and loss or your reserve, okay, P and L or reserve, credit it, that's 2 naira. You're going to debit what now? Debit what? Accrued interest, right? End, right? Which is 2 naira. Do you understand now? That is in the book of what? Of the holding company, the person that is giving out the loan. We credited P and L with the word interest amount, and then debit accrued interest end. Okay, it's more like an asset now. So you can just open bracket interest end from who now? From subsidiary. Now in the book of the word subsidiary now, we're going to say this interest now from their perspective, they are the one receiving the loan, is an expense, right? So they will debit their reserve or your P&L, and then they will now what? Credit what? What we call accrued interest what? Paid. So, or you can say accrued interest payable. So that is what? Parent what? Company, right? So from the perspective of the what? Of the parent company, the interest is an income which reflects in its reserve. And then you debit your what? Accrued interest end. That's the subsidiary now. More like debiting them. Now here, you debit your reserve or P&L because an expense now. That's the subsidiary's perspective. And then you credit your accrued interest payable. Okay, which is parent what? Company. So here you're saying that the parent company is here to pay the interest on the loan. Sorry, the parent company is here to receive the interest on the loan. That's what it means here. Or you can say the subsidiary is here to pay the parent company the interest on the loan. So in the book of the holding company, we're saying that what? The subsidiary is what? Owing the parent company what? The interest on the what? Loan. So we can just say here the sub is a debtor in that sense, and here the parent company is what? A creditor. So we expect that at consolidation, this accrued interest end should cancel this accrued interest payable at consolidation. It should not remain the amount for the reserve in the P&L of the subsidiary and the amount for reserve in the P&L of the what? Of the holding company. So what I've just explained here is simple. What I've explained here is that it is possible to have loan between what? The parent company and the subsidiary, where the parent company is giving out loan to the subsidiary, or subsidiary giving out loan to the what? Parent company. So it means that in the book of the person giving out the loan, you're going to be holding the person you're giving as what? A debtor. In the book of the person receiving the loan, you're going to be holding the person that was given as well as a creditor. Just like what we have here. So here in the book of the parent company, the sub is a debtor because the parent company is the one giving out the loan. We say 10 naira. The book of the holding company now, the parent company is a creditor because the parent company is the one who was giving out the loan. So now, we are saying that we expect that both should be equal at consolidation, equal and opposite. But where it is not, whatever difference, usually maybe the interest end on the loan. Maybe this guy here has what? Has captured the interest, but this guy is here to capture. So that can cause a difference. So that difference must first of all be eliminated. So that I can have the loans cancel out what? Each other. So once you eliminate it by raising the appropriate journal, then you now capture the interest accordingly. So I said for the interest end here, credit what? P&L or reserve. You know, it's an income. The interest on the loan is an income to the person giving it. Parent company is one giving it to the subsidiary. So it's an income to you. So credit your profit and loss or reserve. So we assume 20% on the loan amount here. Then we now debit what? Accrued interest earned. So that's like an asset. The subsidiary now, we're debiting them technically. They are owing this interest. So from the part of the subsidiary now, you know, it's an interest they are paying. So it's going to be an expense. So debit reserve or P&L of the 2 naira, which is 20% of the 10 naira. Then credit accrued interest payable, which means that the parent company is being owed that interest at the time of reporting. Okay? So when we do this now, we expect that the accrued interest payable should cancel out the accrued interest was earned at the consolidation, leaving out credit in the P&L account of the holding company and the debit in the P&L account of the what? Subsidiary. then we can go ahead and consolidate. Now, the essence of all this is when both companies have not taken the necessary step as at the time we are consolidating. But if they have taken the necessary step and when we are consolidating, then it will not arise. Okay? It will just cancel out, and they would have accounted for the income and expense from their perspective. But where they've not done that, we have to ensure that the necessary adjustment is done. That is what we have done here. Okay? So you can have loan in between sub and holding companies, and then you can have interest accrued on it. Okay? They might have captured. If they have captured before we consolidate, that's fine. But if they have not captured, then we have to make sure that it's done before we consolidate. So if you have questions, you can reach on the numbers display. Let's reply with the right answers. Okay? And then don't forget to support us by printing that numbers display. Okay? Or sponsor copies of my textbook for free distribution. So let's quickly go to the consolidated schedule. Like I said, it's still double entry. I've already taught you that in the early classes, but it's appearing in form of what schedule. So you can actually go through other classes to understand the double entry perspective. Okay? So we don't have not to waste time. Let's go straight to the consolidated schedule so we understand what we're talking about here. So let's quickly take this question, okay? So you understand what we're talking about here. So we have the following represent the balance sheet of Kings Limited and Queen Limited as at 2018. So we have Kings and Queens, assets, land and building, furniture and fittings, equipment, debtors, investment in Queens, inventory, cash at bank, current account Queens. We have advance Queens, that like saying loan given to Queens. And then we have like the share capital there, reserve, current account Kings. Okay. Then we have loan Kings. That means in the book of Queens, loan is a creditor. In the book of Kings, Queen is what? A debtor. Okay, so let's go there. So we have Kings Limited acquired 80% shares in Queens Limited on 31st March when its reserve was what? 1 million. So we have Kings Limited transferred the land value at 10 million to Queens Limited. The cost of the land to Kings was 9. I've already taught all these adjustments. Kings Limited had accounted for the interest on the loan advanced to Queens Limited. This is here to reflect in the books of Queens Limited. So here they are telling us that the difference between, of course, we expect that the loan in between the group should be the same thing. But here you can see that the loan that is being accounted for by Queens against Kings here, or in favor of Kings here, is 7.6. Why that in favor of or against Queens here is 10. So there's a difference. So they're not telling us that what the Kings Limited had accounted for the interest on the loan advance to Queens Limited. This is here to reflect in the books of Queens Limited. So apparently, of course, based on the information given to us, it is simply trying to make us understand that Kings are already accounted for the interest on the loan. That is what is making it high. But Queens is here to do that. That's why there's a difference. So the difference we have to eliminate, then we'll not do the appropriate thing, right? So about this, so let's just quickly, do what we have to do. So we have consolidation was schedule. So let's go. What do you have here? Cost of control, which is Kings in Queens. I think it's 80%. Okay. Then we have minority interest here, which is 20%. Then we have consolidated P&L. So here we have what now? The share capital for Queens. That is how much, based on the question there. That's 100 million. So we have 100,000 in that sense, right? Okay. So 80% of 100,000 here is 80,000. 20% is 20,000, right? So the next thing here is going to be what? The reserve for what? Coins. But before we even put the reserve, we must be sure that we have taken into consideration the adjustments, right? So the first thing I'm seeing there, I'm seeing Kings Limited transferred a land valued at 10 million to Queens Limited. The cost of the land to Kings was 9 million. So, of course, that's the issue of what? Unrealized profit on what? On asset. I already thought to transfer of asset. Go and take that class. You understand what we're talking about. Okay? So what do we have now? We have land and what? Building. So it was transferred to them at 10 for the cost. So the selling price here is 10 million. The cost price here is 9 million. So the difference here is what? 1 million. So this is the unrealized profit. So we're going to have to adjust for the unrealized profit. How do we adjust here? Okay, so that will mean that we are going to be what now? This land and building technically has been what? Is that not like an overstatement? We're supposed to hold it at what? 9, we're holding at 10, right? Good. So we're going to credit land and building with 1 million naira, and then debit what? Reserve with what? 1 million. That's to account for the unrealized what? Profit on the land and what? Building. So the next one now, they said Kings Limited had accounted for the interest on the loan advanced to Queens Limited. This is here to reflect in the books of what? Queens Limited. So what is the loan given out? Loan accounted for by Kings against Queen is 10 million, while Queen is saying 7.6. So what's the difference? So we have loan difference. So we have King's book is saying what? 10 million. Queen's book is saying what? 7,600,000. So what's the difference? I think that's 2,400. So we have to reverse this first of all, so we can have it, equal. So the book of King 7.6 happened to be loan, but the book of Queens 7.6 million happened to be loan. But they're saying that what? Kings have already what? Accounted for the interest. So let's reverse so it will be equal. So in the book of Kings, I'm going to reverse the interest that they've done. Okay? So we have to debit that what now? Debit that reserve and then credit what? The advance now against Queens. So we debit reserve with how much? 2,400, and then credit what? Advance, that's Queens, 2,400. So when we do that, it will what? Reverse the difference and make that advance against Queens to be 7,006. So that will make the loan in both books to cancel out. So once we've done that, we'll now account for what? The interest element from both perspectives accordingly. So we say King's book now. Okay? we'll do the right thing because it's an interest end. It's an interest end. So being an interest end is an income to them. So we're going to now have to what? Credit what? Reserve with how much is the interest? 2,400. And we debit accrued interest what? End 2,400. Okay, that is big against what? The sub, right? Now, in what Queen's book, let's do the right thing. The interest of 2004 is an expense. Okay? So, what do? We debit the reserve with 2,400. Then we now credit what? Accrued interest payable. 2,400. That is against the what? Parent. Which is what? Kings. Yeah. Sub is queens. So after doing that, at consolidation, this guy will cancel this guy. Okay, it will not bring just this guy and what? This guy. So any other item there? Any other item there? No other adjustment. So let's just quickly, raise or enter the journals, right? So let's enter the journals here. So what's the first thing I'm seeing here? Land and building. Land and what? Building. What's the balance brought for? Land and building, in the book of the sub there, is what? 50 million. So we have 50 here. So creating land and building now. So we have unrealized profit of what? 1,000. So new balance is 49,000. So our land and building has changed from 50,000 to 49,000. What's the next thing here? The loan difference. Okay, the loan difference. What's the loan difference here? Let's go. We have, that's King's book, right? So we have advance. Against what? Queens. Balance brought forward is what? What do you have? 10 million. So we have we have 10 million. So there is a credit towards to the advance. Sorry, it's a debit. So we have balance brought forward. It's a debit. Yeah. So there's a credit to here. So we have what now? Reserve. How much? 2,400. So the new balance will be 7,600. So this will make it equal and opposite with the one in the book of what? Coins. Okay. So what's the next one? That's what we've done here is just to adjust so that we can have the advance in the book of Kings to be the same thing or equal and opposite with one in the book of what? Coins. So we have them cancelling out and consolidation. Okay. So now we have to open what? We have accrued interest end. Accrued interest end. What do you have? It's a debit here, right? So we'll say what? Reserve. How much? 2,400. Yeah. we say what? Accrued interest payable. Credit, so we say what? Reserve 2,400. So you can see that this will cancel out this at consolidation. The next one now is the reserve. So we have balance brought forward. What's the reserve of Queens? The reserve of Queens, what do you have there? 18,550. 18,550. So there's one debit here from land and building on what? Realized profits, land and building. What do you have? 1,000. Okay. So this is the book of Kings. This is another book of Kings. So we have another one here for Queens. Your debiting reserve is 2004. All right. Yeah. So we have interest payable. Okay. How much is that? 2,400. Right. So what's the difference? We have a new balance for reserve in the book of Queens. We have 18,550. 18,550 minus 1,000 minus 24. 15,150. So we have 15,150. So the new reserve for Queens is 15,150. You have 15,150. Okay, so what is the reserve for Kings? Balance brought forward. What's the reserve for Kings? Yeah, 104,500. 104,500. That's the King. There's a King's debit here, right? So we have what? Advance, which is 2,400. Okay, then there's a credit here. Which is interest earned, okay, of what? 2,400. So there's a shortcut to it, so I don't go this, but we're trying to just eliminate it so that we now have the appropriate position. So apparently you're still having the same balance after all. Okay, so at this point we can now split to pre and post. So we have we have 15,150. Pre, according to the question, is 1 million. So we have 1,000 here. This will be what? 14,150. The minority interest will be 0.2 times 15,150. 0.2 times 15,150. We have 3030. 3030. Then this will be 0.8 times this, 0.8 times this. So 0.8 times 1,000, I think that's 800. So we have 800 here. 0.8 times 14,150. 11,320. We have 11,320. 20. So if we add up, it should give us the same thing. We have 11,320 plus 3030 plus 800. 15,150. So that's it. Let's proceed here. So here is 008. So that's 80,800. Here we have 0303 23030. So this is the net asset acquired. So bring in your investment. The cost of investment here is how much? Kings had invested with how much? 90 million. So we have 90 million. So this is going to be a goodwill, debit balance goodwill. So 90 million minus 8,800, 9,200. So this is going to be debit balance goodwill. We already thought that, okay? So here you have 23,030. Okay, this is your minority interests. So you bring your what? King's Reserve 104,500. When you add up, what do you have? 11,320 plus 104,500. This is 115,820. 115,820. So this is your consolidated what? Reserve. So let's go now. We say what? Kings and its what? Subsidiaries. So we say statement of what? Financial position as at 31st December 2018. Okay, before we proceed, let me explain. What we have done here basically is to prepare group balance sheet or consolidated balance sheet. We're trying to pay attention on inter, group or intra-group loans, as loan within the group. Okay. So what we're saying is that the holding company is giving out loan to the subsidiary, so they're giving out loan to the holding company. So that's what we're able to do here. So there was a loan, but at first it didn't agree. So we have to first of all eliminate the difference so that it will cancel out. Okay? So after doing that, we also now did the proper adjustment for the what? Interest item. The perspective of the holding company that is giving it an income, we took the journals. The perspective of the subsidiary is somewhat expense, we took the what? Journal. So we now have balances cancelling out. So the accrued interest here is more like what? A debtor, coins. Counting at the accrued interest payable here, which is like creditor kings here. That's what you're seeing here, cancelling out. Okay, so the advance limit to Queen has now gone back to 7,067.6 million. That is in the book of Queen. That will also what? Cancel out. Okay, so that we can now what? Consolidate. So let's go. So we have our notes. So let's say notes 1, because these are assets, right? Non-current. Okay, so let's put that here. Note 1. So what are the non-current items there? We have what? Land and building. So we have land and building. That would be the new value of land there is 49 plus what is the holding company of 60 million. So 49 million, 49 plus 60, 109. So we have 109 million. So what's the next one? The furniture and fittings there. 35 plus 30, that's 65 million. So furniture and fittings is 65 million. Equipment is 7 plus 4, that's 11 million. equipment is 11 million. Any other item there? No other item. So let's add up. We have 109,000 plus 65,000 plus 11,000. 185,000. 185,000. So what we have done here is basically to consolidate the what? Non-current asset, which is your fixed asset position. So we're taking that of the holding company and that of the subsidiary, we're adding them to get one value. But for the land and building, there was an adjustment, so we took the new balance. Okay, it was 50 million before consolidation, so we adjusted based on the what? Unrealized profit difference, so it became 49. So we added up to what? The 60 million to get what? 109 million. Okay. All right, then furniture and fittings there. We have 35 million for holding company, 30 million for one subsidiary. That's 65. Equipment is there. We have 7 million for holding company and 4 million for one subsidiary. We added it up. Okay. So here we have 185 million. So let's go current. Note 2. So let's put that here. Note 2. So what are the current asset items? Of course, we have what? Inventory, and then we have cash at bank. Okay, and then there's debtors. So what's that debtor there? Debtor, according to the question, we have 20 million plus 37,650. We have 57,650. 57,650. What's the next item? Inventory. Inventory here we have 13 million plus 9 million, 22 million. What's the next thing there? Cash at bank. We have 34,500 plus 30,500. We have 65 million. Let's just call it bank. 65 million. So let's add up everything. So we have 65 million plus 22 million plus 57,650. We have 144,650. 144,650. 144,650. Let me explain. So what we have done here is to add up the current asset items, okay, for the holding company and the subsidiary. So the debtor, we had 20 million for holding company, 37,650 for subsidiary. We added it up to get 57,650. For inventory, we have 13 million for holding company. We have 9 million for sub. So we added it together to get 22 million. Bank, we had 34,500 plus 30,500. We added it together to get 65 million. Now, so when you add these two, you have 144,6. That's what you have here. So the next thing now, there's a goodwill here. So we have our goodwill. Daily balance goodwill. I already told you how to test that. So we have 9,200. So we add up. What do you have? We have 185 plus 144,650 plus 9,200. We have 338,850. 338,850. So let's go now. Liabilities now. So what's our reserve? Our reserve here is 115,820. Then what's our share capital? The holding company share capital is how much? 200 million. Then what we have, minority interest is what? 23,030. Now, remember that there is advance to Queens in the Book of Kings. The new balance is 7,006 debit. Now, in the Book of what? Queens, you have the loan taken from King 7.6 million. So it's going to be equal and opposite, that's credit is debit. So it will cancel out. So there's no need. It won't come to the consolidated balance sheet. Okay? And the next one is the accrued interest earned here. You can see there's a debit here, there's a credit. It will also cancel out, so it won't come in there. Okay? Then all other ones have been entered in their respective ledgers. So the reserve here has been what? Adjusted for. That is what we brought here before what? Adjusted. The same thing with the Kings. Okay, so we can go ahead and balance up. We have 115,820 plus 200 million plus 23,030. Okay, so we have 338,850. So this is your total assets. This is your total liability. So you can see 338,850, 338,850 after taking into consideration the necessary adjustment. So take your time, go through the class again. If you have questions, you can reach me on the numbers displayed. Don't forget you can support us by printing the account numbers displayed. Okay, or sponsor copies of my textbook for free distribution to students. Thank you and see you next class.